want to continue my discussion of the initial public offering process. Now, one way for securities to be issued is using the process of underwriting. And in underwriting a stock or a bond issue, the investment banker purchases the entire offering at a predetermined price and then resells the offering in the marketplace at a higher price. So essentially they buy wholesale and sell retail. So they might pay the company $95 per share and then try and sell them for $100. Okay. They also provide other services. These investment bankers provide a number of services other than just helping them to sell their securities in the marketplace. They give advice, they help in filing documents, and they help in the underwriting process. So let's go through some of these. Okay, giving advice. What kind of advice do they give? Well, they can help by explaining current market conditions to help determine what type of security to issue. Should they issue equity? Should they issue debt? They also assist in determining when to issue and how much to issue, and also at what price should the securities be issued. This is not a trivial task. Sometimes it's easy to know when's a good time to issue because the initial public offering or the IPO market is hot, as they say, and a lot of firms are going public, and there seems to be a lot of demand to buy these securities. But it's hard to know exactly how much to issue and at what price to issue. Oftentimes, what these underwriters or these investment banks will do is they'll take the firm through a road show. And in a road show, they'll go out and try and generate demand for the issue, for the securities, by meeting with institutional investors and pitching the company. You know, what do we do? What does the management team look like? What's the vision for the management team? It used to be you had to be an institutional investor and invited to these, but now a lot of these actually appear online. You can go to a place, I believe it's roadshow.com, and you can actually see the CEO or some other management person presenting at this roadshow. They'll have, PowerPoint slides, and they'll discuss what's the vision for the company. Filing documents, that's another part that the investment banking house helps with. SEC registration is required for issues greater than $1.5 million and with the maturity greater than 270 days. Now that's why in certain short-term securities like CDs, certificates of deposit, not the CD you get at your local bank, but these large certificates of deposit that are short-term IOUs are used to finance things like car loans, okay? Something like GMAC. I don't know if GMAC still exists, but GMAC used to be General Motors' financing arm. They set it up to help people buy cars. And they would issue commercial paper, and that money would be used to finance the loans, and they'd issue them with maturities less than 270 days, so they didn't have to file. A portion of the registration statement known as the prospectus is made available to the public, and I'll discuss a little more about that in a second. Debt issues may require several additional steps. The investment bank may go and help the firm get a credit rating. You may be familiar with Moody's or Standard & Poor's. These are rating agencies. Okay, they're sanctioned by the government to rate the securities, but they don't just rate whatever pops up. You actually have to go to them, and you actually have to pay them to rate the issue. You may hire a bond counsel. You may go through the process of getting bond insurance if your rating isn't going to be strong enough. That'll help you get a lower interest rate. There are other things you can do. For equity issues, the investment banker may arrange for the securities to appear on one of the exchanges, like the New York Stock Exchange or the NASDAQ. And again, which exchange the firm appears on depends on, what the goals of the firm are, what the listing requirements are. Some companies aren't big enough to be on the New York Stock Exchange. Okay, what's in the prospectus? You hear the term prospectus a lot. A lot of times you'll see these commercials, and you'll hear them say for mutual funds or all kinds of securities, and they'll say, this is not an offer to sell. That can only be done by getting the prospectus and call this toll-free number or go to this website and download it. What's in the prospectus? Well, it includes information that would be relevant to investors, things like risk factors, use of funds. Okay, once the company goes public and they raise all this money, what are they going to do with that money? There should be some financial information there. Okay, what's their profitability? How much debt do they have? What does their inventory look like, et cetera, et cetera. Okay, management will probably have a discussion and analysis of the financial condition. There may be an industry overview. Who are our competitors? Okay, what is it we do? How competitive is the industry? Okay, an overview of the business. Some information about the management and the board of directors. If you were going to invest in this company, you'd want to know who the CEO was, what his or her background was, what their experience is, who are on the board of directors, etc., etc. Okay. Continuing the underwriting process, I said before, what the underwriter does or the investment banker does is they purchase the entire offering at a fixed price and then resell the offering to the market. What this does is it transfers the risk of changing demand, and by that I mean changing prices, from the issuing firm to the underwriter. So in order to diffuse some of that risk, an underwriter may form an underwriting syndicate. And the reason they do that is some of these offerings are very, very large. Okay, I mean, Goldman Sachs has no problem underwriting a few $1 million issue, but if it's a $5 billion issue, that's an awful lot of risk for them to take. So they'll get a syndicate of other investment banks to help them sell the securities and also to take a piece of it so they don't have all the risk on their books. You'll have something known as a Tombstone Add that appears in the Wall Street Journal, for example. Now, they call it a Tombstone Add because it kind of looks like a tombstone. It's kind of this rectangular shape. And this is the case for Google. It tells you how many shares, what kind of security is. In this case, it's Class A common stock. The expected price range, the range that they expect to issue the securities for. Here it's 108 to 135. And then here you have the different investment banks. Okay, I don't know if you can read that there, but it says joint book running managers, and you have Morgan Stanley and Credit Suisse First Boston. So they're the lead underwriters. And then you have a number of other underwriters here that are also buying shares: Goldman Sachs, Citigroup, Lehman Brothers, which is no longer around. But these firms are also taking a piece of the action. Now, the goal of underwriting is for all the shares in an offering to be spoken for. Okay, but this doesn't always occur. Okay, the goal is for it to be essentially fully subscribed. That is, all shares are spoken for. So if you're issuing 1 million shares, okay, you have commitments for institutional investors to buy all 1 million shares. Sometimes the offering is undersubscribed. That is, there isn't enough interest and there's still a lot of shares available. Okay, that's a lot of risk to the underwriter. That's why they go through the roadshow. They're trying to make sure that there's enough interest and that they want to price it correctly so that people will be, or institutions will be interested in purchasing the issue. It can also be oversubscribed. Okay, sometimes you get a really hot offering. Netscape years ago when it came out, eBay, more recently Twitter was a hot IPO, and oftentimes they're oversubscribed. That is, there's more interest than there are shares available, and sometimes there's a rationing takes place so that a company may want to purchase 1 million shares of these, but they may not get the full 1 million. Okay, a couple of other approaches for underwriting, or actually not technically underwriting, but for issuing securities. One's known as a best efforts approach, and this is a case where a firm, rather than have a firm commitment, rather than the firm buying the securities at a fixed price, what the underwriter does is they make their best effort to sell the entire issue. So this is the case, for example, like a real estate broker. They sell a house for you, but they don't buy the house from you. So if they can't sell it, they can't sell it. Okay? They make their best effort. If they've succeeded in selling it, they get a commission for doing so. Okay? Compare that to the underwriting approach. That's more like a dealer. Think of an antique dealer or a baseball card dealer. In this case, the person will buy that baseball card from you, and they'll buy it for a price lower than they think they can sell it for, and then they'll turn around and try and sell it. But if they buy it from you and the demand for that player's card goes down for whatever reasons, maybe they were using steroids and people aren't interested in their card anymore, then all of a sudden they're stuck with a baseball card they may have paid $1,000 for. They thought they could sell it for $2,000. They can't sell it. Another approach is known as a private placement. And this is the case where the issue is sold to a small select group of investors. It's not done with equity issues very often, but it's done with bonds or fixed income quite often. So this is a basic introduction to the IPO process, which is the case where a private company goes public and becomes a public company that you can watch, and you can see quotes on the on the New York Stock Exchange or on the NASDAQ. You can go on the internet and find out how the stock price is doing.